afternoon. Welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and impact. I'm Govindraj, Ethiraj. The big development this week was a reduction in the statutory liquidity ratio by the Reserve Bank of India Governor Raghuram Rajan. Here's a report.
RBI came out with its 6th bi-monthly monetary policy review on Tuesday, and there were no surprises on RBI Chief Raghuram Rajan's birthday. The central bank decided to keep lending rates unchanged after a rate cut on 15th of January outside policy review cycle. The repo rate at which RBI lends money to banks remained at 7.75%. Cash reserve ratio, the amount of funds that the banks have to keep with RBI, was left unchanged at 4%. To encourage banks to lend more, the central bank reduced the statutory liquidity ratio by 50 basis points to 21.5% from 22%. SLR is the minimum portion of net deposits that banks must hold in government bonds. RBI governor said that further rate cut may not happen before the union budget.
And that it will depend on developments, in particular on developments on the fiscal front, as well as a continuation of the disinflationary process.
Industry expressed its disappointment as falling inflation had rekindled its hopes of cheaper loans.
जनवरी 15 के बाद ऐसा कुछ नहीं हुआ है कि फिर तुरंत और एक रेट कट करना जरूरी हो गया था.
Analysts feel that the monetary policy stance of the RBI is on expected lines.
As an industry voice, we have been asking for a reduction in the interest rate. Hopefully, at some point of time, we will have a more substantial interest rate cut.
However, the Reserve Bank has increased the amount Indians can invest or spend abroad in foreign exchange without seeking its permission. Individuals can now buy property abroad, hold shares or debt instruments, or purchase gifts up to a limit of 1.5 crore rupees per person per year.
Well, joining me now to discuss how the credit policy is going to play out is Soumaya Kanti, Ghosh, Chief Economist at the State Bank of India, and former Chief Economist of the State Bank of India, Dr. Brinda Jagirdar. Thank you very much both for joining us. Soumaya, let me begin with you. A 50 basis points in cut in statutory liquidity ratio. What does that mean for the system at large?
See, the cut in SLR is primarily, their objective is twofold. The first objective is to help the banks in this liquidity coverage ratio, which comes into effect from January 2015, and the second thing is that the SLR cut is basically to enthuse the banks that as and when the credit demand picks up, they have sufficient resources at hand so as to on-lend to the productive sectors. There is a third angle to it, which I believe could also be an indication, a signaling mechanism by the central bank, is that a cut in SLR is likely to, what it is likely to do is that it is likely to signal to the government that the fiscal consolidation path which they are on, they should continue to be on that path, because a lower SLR in effect implies indirectly that the government should not go ahead with a larger government borrowing program in the forthcoming budget. So I think it's a good initiative on the part of the Reserve Bank to have taken this path forward.
Brinda, how are you seeing it? Is it sort of falling into place? Interest rate cut in the beginning of January, some release of SLR. Leading up to the budget, which of course people are expecting it to be good and so on.
Absolutely. I think this excessive focus on rates, because the policy is not just about rates, it's about rates, it's about reforms, it's about regulation. So I think here it's a very good balance that the governor has come up with. Now on rates, he said, I'm standing by. I just need to look at the data which will come out. I need to see the GDP data, because suddenly we find this revision from 5% at market rates to 6.9%. at a time when he feels that the economy is not rollicking, as he says. So, but he says, I'm standing by. On reforms, we find, what has he done? He has reduced the SLR, which has given banks a lot more room for liquidity to lend. He has done away with the sectoral refinance, which again is an Urjit Patel committee recommendation. And he says, I'm going to provide system-wide liquidity. Then he has introduced something new called the unbreakable deposits, which will allow banks to lend long term. And he's talked about, of course, we have got new banks, the payment banks and the small banks. And there's a lot of flexibility on the NPA front for banks, operational flexibility for banks to lend. So that's on the reform side. On the regulation side, he has introduced the liberalized remittance scheme. He has liberalized that, and he has allowed the investment limit for G6 that has been reached. I mean, that has been reached by the FIIs. So now he says, I still want you to stay. So I'm giving you an option. The coupon, you can reinvest. Now the coupon, 30 billion limit, coupon at say about 8% comes to about $2.5 billion, which is not a huge amount, but it's sending out a big message that we would like you to stay here, but we'd like you to stay here for a long term.
Yeah, okay.
Similarly with corporate bonds, he says you can invest. There's still a limit, only about 62% of the 51 billion limit has been used. But he says, I'd like you to stay on here, but invest long term.
Right. So you said regulation, rates and reform. So which of these three you felt was the most significant in this credit policy?
Think all of them were equally important, but I think where what he has done for the banking sector, nudging them to lend by giving them greater liquidity, helping them clean up the balance sheet by saying excess provision that you have made, you can write it back in case the asset is sold. And also there's a lot of flexibility in case a new promoter comes in, and so giving them that the tenure of the loan is extended, the COD, which they call the date for beginning their operations, that also has been, there's a lot of change and that has been expanded in case a new promoter steps in. So all this is going to give banks a lot of comfort in supporting the growth that the economy is poised for.
Right. So, Soumaya, I don't know how you are sort of dividing it, but are you? Would you like to walk us through how you think the Reserve Bank strategy is playing out in terms of reform, in terms of rates, in terms of regulation, and on what are you placing more emphasis at this point?
See, I will first start with the interest rate signal. I think after that, of the budget, of the policy cut in January, the governor had indicated that maybe the next time could be cut in the policy. So possibly another 25 basis point cut in April policy itself. Now, having said that, there are two aspects to that. I mean, the impact of the transmission mechanism. I mean, if you look at the historical evidence, if you actually look at the examples of the Fed, and if you look at the examples of the European Central Bank, we will always find that the impact is the transmission mechanism asymmetric, which means that whenever the rate goes up, the banks may actually increase the rates, maybe not with too much of a lag, but whenever the rates decline, I mean the signaling rates are reported, which I am talking over here, it takes a little bit of time on the part of the banks to reduce their lending rates. This is because typically what happens, and as you have seen in India during the period 96 to 2000, is that the banks and the marketplace needs to be convinced that the central bank is on a rate easing cycle. So what it implies for the Indian market is that after some point of time, the lending rate should obviously start going down. When it starts going down, that's a matter of debate, but given this logic of asymmetric transmission mechanism, I think it will take, it may not be too significant time before the banks also start passing on the benefits. Now, this is on the interest rate front. The other front, I think there are two policy steps which has been significantly, primarily on the restructuring one. One of the restructuring norms which the banks had been saying for a long time is the date of commencement of the commercial operation, that the DCCO norms. So what the banks are now given the flexibility that for any projects whereby the project has been stuck because of reasons which is convincing enough, the banks get the freedom that they could actually look at the provisions and they could reduce their provisions and may not keep adequate the provisions for them. So that will also give a very good flexibility to the banks, operational flexibility to the banks in terms of a lower provision. The second option, which also has been our bank also has been making, is basically the takeover of the companies which are not doing well of the promoters. And here the RBI has given a clear signal that for a conglomerate, it could actually look into tweaking the SEBI provisions, that 30% of the total share could be over there, and this is a very game changer, and it could actually lead to banks taking over the management of the SIC companies where the promoters is not playing a the lead role. So that is that is very fundamental. This has been the practice in advanced economies, and if this goes through, I think this could be a very well step on the part of the banks. So overall, I think there is a lot of emphasis on restructuring of the norms. The banks has gotten a lot of reforms in terms of improving their asset quality. There has been also some of the important norms like reinvestment of the coupons. That's a positive step. There is also this liberalization of the outward remittances. So all in all, a very comprehensive policy. So we should not look into isolation in terms of only an interest rate policy decision.
That's actually an interesting point, the liberalization of outward remittances. I mean, one is the amount, in which I'm sure some people, those who invest outside, will be happy, Brinda, but it's also a reflection of the fact that we've hit record reserves, foreign exchange reserves. Is there an impact that we should be looking at beyond that?
You know, I wouldn't say we've reached a record, because compared to our past, yes, it may look good, because remember, there was a time when we did not have even 15 days of import cover. So compared to that, we are certainly better off, but not compared to, say, other countries like China and things, and who have huge reserves. But what it is signaling now is saying that there is a shift. We need to look now. Remember, the ECB, Japan, and maybe even China, to counteract their slowdown, the stimulus from China. So all this is going to release a huge flood of liquidity into the market. And given our growth, it's quite natural that this money will flow in. But if we are not prepared to absorb this, then what will happen is that our rupee would strengthen, and this would hurt our competitiveness. And it would hurt it at a time when the whole global economy, I mean, there's a currency war literally going on there. So at this stage, Reserve Bank says, let me do whatever I can. So the governor has allowed this liberalization, liberal outflows.
Let's take a break on that, but we'll come back and talk about a couple of things. So one is we're going to get some corporate reactions on the credit policy, and the second thing is we'll try and understand how this is setting the stage for the union budget, including the data numbers that we've been talking about, and whether they're falling in sync with the general thinking. Stay with us. You're with Policy Watch.
Hottest topics.
If you can facilitate the opening up and the expansion of the international border trade, you can add to the economy.
370 धारा जो है वो जम्मू कश्मीर को मुल्क के साथ जोड़े रखती है.
Candid confessions.
The Congress has not been able to communicate.
We have to revive our links with the masses.
World-class healthcare is available to only a handful of people in this country.
Causing controversies.
A lot of leaders today think that they rule by divine right.
Now, media has become manageable.
Watch RSTV engage personalities to the point. Every Wednesday, 10 p.m., Thursday, 1:30 and 5:30 p.m.
Welcome back. You're with Policy Watch. We began by looking at the credit policy and its outcome. Let's get a few corporate reactions. We are joined by Suresh Senapati, Chief Financial Officer of WIPRO. Mr. Senapati, thank you very much for speaking with us. Just a broad sense, if you could give us on how you see the monetary policy and the increase in the statutory liquidity ratio.
I think the good thing about this new RBI governor, or I can't say it is any new anymore, is that he's pretty transparent and on making people understand his mind. So clearly he's looking at a roadmap, which is basically trying to see how can we have a real interest rate of 1 to 2%, and clearly to see that how can we have a much more consistency with respect to the interest rate. Otherwise the cost of capital goes up, the kind of a disruption it creates in the society becomes higher. So my own sense will be, clearly the interest rates will come down, but it will come down in a gradual manner which creates less disruptions and becomes much more predictable than it has ever been. And I think enough hint to that effect has been given by the RBI governor.
Are you happy with the sense of liquidity that you're seeing in the system, though it may not affect you directly, but from what you can observe around you?
I think the liquidity in the system has been regulated by the RBI for quite some time. We haven't, there are multiple instruments that they have been dealing with. And as you see the economy sort of moving upwards, the demand going up, the offtake going up, you will see much more fund flows happening from the global world, either in the form of a debt or an equity. Equity market is looking good anyways. And RBI has been managing the liquidity position very well with a view to keep the inflation intact or the interest rates intact. And I would assume that as you go forward, the interest rate softens, there will be unlocking or release of money that will take place to meet the demand, growth demand in the country.
Right, so we're also trying to draw an arc beginning with the interest rate cut and going on to the union budget, and trying to see whether this all fits into a larger scheme of things or a larger directional move or set of moves from the Reserve Bank as well as, of course, the Government of India. So what's your sense and what are your expectations from the union budget?
A lot. I think the first budget, which was after 45 days of the new government, was pretty encouraging. And we have already seen, and he's talked about tax terrorism, he's talked about superior administration, predictability, retrospective tax, and so on. We have already seen some elements of that. And there has been discussion that is happening with the corporate world and the government, the industry associations, and we're seeing the government very, very positive about it. The other thing that we're seeing is there are a lot of stuff that the Prime Minister has talked about, such as Digital India, such as Innovation India, such as Make in India. Now, all this in some form has to operate in ecosystem. So it is not necessarily one is talking or ease of doing business. So we would expect more of these things, A, in the form of an FDI, B, in the form of manufacturing encouragement, which is, let's say, today there are disconnects between the components duty structure versus the finished product duty structure, as a result of which manufacturing is disincentivized. Or you find that the way the exchange rate regime has been, it has always been a problem to do manufacturing because it has subsidized imports by keeping an artificially overly priced rupee, and which has therefore neither encouraged manufacturing nor encouraged exports. So right pricing of the currency will definitely go a long way. Now, similarly, a lot of investments today are happening in the form of technology overseas because making those investments in India becomes very expensive. For example, data centers, whether it is for Indian market or global market. So even if for Indian market, people tend to have data centers overseas, despite the fact that they are meeting the requirement of the Indian market. Now, but if there are better economic environment, the data centers can be invested here, can be set up here, as a result of which it becomes bigger, big hub, it will create employment and create more investment. So I would expect many more acknowledgement of some of those initiatives and in some form reflecting that in the tax policies and the financial policies of the government, economic policies of the government.
Right, and would there be specific issues that you would like to highlight in the context of the budget? Yeah.
No, clearly, like I think, there are a lot of anomalies on the duty structure. There will be a lot of anomalies in the Income Tax Act, as well as the service tax, value-added taxes. We're seeing, we would expect lot more positive communication coming on the labor laws, because while that is not necessarily something to do with the finance budget, but at least that directionally government has always talked about it. Our expectation is that it will find some place, and I think acknowledgement of the fact that if manufacturing has to happen in India in a big way, what are the various steps that the government of India is going to come up with? There has been a lot of consultations in that respect. So we'll see we would expect some of that to be reflected in the policies.
Right, Mr. Senapati, thank you very much for joining us. Let's return to our guests here. So, Brinda, let me begin. So, you know, the Reserve Bank governor said, and like I said, we're trying to see if there's an arc. He was waiting for three things: GDP numbers, inflation numbers, and of course what the budget itself will say. So, the budget will say what it will say, but let's look at GDP numbers and inflation numbers. Is there something there to give cheer, or is there something to cause concern?
I think we need to really look at it a little more closely, because there's a lot of revision. One is accounting changes have taken place, but at the same time, corporate performance has not been all that good last year, and there is still a lot of slack in the economy, excess capacity. So given all this, it's suddenly a little difficult to see how the economy was rollicking, to use the governor's word. So, but at the same time, there are enough signs that the economy is picking up. So we just need to see.
But this is talking about a pickup that happened last year.
Absolutely.
And the year before that.
Yes.
Yeah. Okay.
There was in the nominal GDP for the FY14 there is no change, but FY13 the nominal GDP has been reduced. So there is some accounting changes that have really shown this figure. So we would need to see how much of it is actually because of real developments and how much is because of accounting.
Okay, so let's see if Soumaya, your bank, the State Bank of India, has a manufacturing index. Now you've released the latest numbers for January, and do take us through that. But what's your sense when you look at what you're measuring versus these new revised numbers?
See, I think the State Bank Composite Index actually looks into the index based on the IIP data and also the lending portfolio. See, if you look at a January number, the numbers what we have got the number is that is actually declined from the December one. So the December number was at a 3-month high, the January number is at a 3-month low. So that means that on a month-on-month mode, the momentum is clearly declining. So that's a cause for concern, even though the year-on-year growth looks better, primarily because of a lower base last time. So I hope that the December and January will both get a good IIP number, though the January IIP number will be lower than the December IIP number. So this is regarding.
If I can interject here, what within this manufacturing index is not moving, or what is causing the drag?
See, I will tell you, what is actually happening is the credit growth has been at a very low levels, and if you look at the credit data of all scheduled commercial banks, what has been showing a traction interestingly in the current year is the loans to the credit card outstanding, and which could be possibly because of this e-commerce revolution. So, but that is not directly adding on to any sentiments revival on the ground. So, it's for example credit uptake to the large corporate sector, to the MSME, to the other sectors. So, if you look into all these aspects, I think the IIP is still going to show some amount of growth, but it will not be that encouraging so as to say that indeed a revival is taking place. Now, regarding the...
So, if we were to look at the revised GDP numbers, how do we then treat them? I mean, because we are talking about policy response on basis, or other basis these numbers, aren't we?
See, I will tell you about the new GDP numbers. So, the new GDP numbers, I have looked at the numbers a little bit carefully. One thing which is coming out clearly from the data is that the GDP growth rate, which was 4.7% last year, has moved up to 6.6%. But if you look into the nominal GDP growth rate, that number is actually stayed at the same level. So, what does that imply? It implies that there has been a redistribution of the nominal GDP growth rate to the inflation. So, I mean basically the deflator level. So, I think the much of the revision could be possibly explained by the decline in the inflation which has started happening last year, and that's why that is getting reflected in the GDP number. And the other thing which is coming out from the number is that the manufacturing numbers has been revised significantly upwards. But if you actually take the construction within the manufacturing, that has shown a, because construction sector has been shown a degrowth in 2012-13, I think around -4% or so. So if you actually take the construction within manufacturing, which is the methodology which is followed, so in that case you will see that the manufacturing sector has not shown that growth rate which a lot of people is talking about. The other thing which you see over here, now the manufacturing sector numbers are mapped to the MCA 21, that means the Ministry of Corporate Affairs returns which are over there in the Ministry of Corporate Affairs. And one thing which is coming out clearly from the data is that there is a lot of numbers, like for example the CSO is talked, just give an example, for example like production taxes or production subsidies, which means for example land registration fees, which are getting reflected in the new number, and but the on the other side, on the flip side, even though there may not be an increase in the production, this number may show a higher amount of manufacturing growth. So in my sense, the new numbers are good in the sense that it gives a very comprehensive coverage, but we need to look beyond the new numbers, because there is a lot of things which has happened in the CSO definition. Another thing which I just thought I will just mention this in a passage: savings, the valuables. The savings has the valuable numbers had been adjusted, and a part of the savings has moved into the savings, household savings. So therefore, you will see a dip in the household physical savings and an increase in the financial savings. So we need to look into in a total context, but it's a good thing that the CSO has revised the number in accordance with the international best practices.
Right. Okay. So we said GDP numbers, inflation numbers, interest rates are lower. Of course, commodity prices are down, oil prices are down. What kind of environment is this? I mean, it sounds like a good thing, but how do you as an economist see this environment in the run-up to the budget? And therefore, the eventual question is what needs to be done, or what else needs to be done?
To this long list, let me add one more, that is the fiscal deficit.
Okay.
So the governor has said, I am looking at targeted subsidies and increase in capital expenditure. So therefore, he wants to see a high quality of fiscal adjustment, not just the numbers. So, and at the same time, look at the outside environment. I think there's increasing risks in the global economy which he needs to prepare for. So while we have a lot of comfort coming in from the numbers that you just mentioned, on the domestic side, definitely there is a lot of improvement, but on the external side, because we are really linked to the global economy, so there seems to be some concerns there. So overall,
you're saying because of quantitative easing
and commodity prices.
Yeah.
Look at crude, for instance. Again, it seems to be trending up, and there's a lot of uncertainty on that. So, so we just need the governor will have to. I mean, he says, I want to look which way the data is moving, how much of credibility there is in the data, and then I will.
Fair enough. So that's the monetary side. So as we go from monetary to fiscal, to complete the arc and our discussion, what needs to be done or can be done in from at least as viewed from Win Street perhaps by the budget?
The budget will want to, the street will want to see the budget give a thumbs up to manufacturing and to growth. So that is the one single biggest thing that they will be looking out for.
Second, and that will come from?
That will come from the budget. For example, the investment allowance, things like which they announced last year.
Okay.
So measures like this, which is going to really give a fillip to investment. And to growth and investment, and like for example, even from the imports. So if the commodity itself is going to be priced cheaper than your inputs, then it's really you'd rather import rather than produce at home.
Right.
So things like this will have to be corrected. So that's so far as the growth is, the investment is concerned. Then of course on the tax side, foreign investors will be looking for reassurance on stability on the tax front, and GST, what the government has to say.
And that's really an older wish list as well. Soumaya, we're trying to complete the arc, right? So we began by saying there was an interest rate cut in the beginning of January. We saw a cut in SLR and therefore an increase in liquidity, which seems to dovetail with that. And let's now understand how we are preparing for or should be preparing for the union budget, which is a week ahead, and how could the arc be completed in a manner of speaking to obviously bring about a sort of greater macroeconomic, sort of sounder macroeconomic future?
I think the budget, the first thing is that we need to, if I just look into the growth aspects, I think there should be some provision of pump priming the capital expenditure, and that could be done on actually goading the public sector enterprises, because they have a lot amount of sizable cash balances to start spending so that the growth revival picks up. And this time the job will be easier because the subsidy number will be on the lower side given that the current scenario in the oil. So this is one thing which I will be looking very closely into the budget. The other thing I think that the finance minister has indicated that the other steps regarding, for example, credit to the different sectors. For example, agricultural sectors, we are actually looking into some sort of a new definition of the priority sector lending, which could be up the possibility in the budget. There could be also some mention of the banking sector roadmap, because a lot of thing has been discussed in the Gyan Sangam in the January one. And the other thing is regarding is the government is also may tweak the taxation limits for the household sector so that the savings actually goes up, and this could be a continuation of the efforts which was made last year when the exemption limit on the housing loan had gone up, the PPF amount was gone up. So I can see some amount of tweaking also over there. So overall, in the whole, some sort of an higher fiscal deficit we could envisage in the budget, so it could be higher than the 3.6%. And the other thing which the government could see is that how it could revive the savings of the household sector.
Soumaya, thank you very much for speaking with us and joining us today. Thank you, Brinda, for joining us as well. That's all we have time for on this edition of Policy Watch. We'll be back next week, same time. Thanks for watching.